Hello everyone, this is BHAVIK CHOKSHI this side. Hope your preparations for November 18 are going on in full swing. Well, this video is specifically dedicated for the discussion of RTP for November 18. This is pertaining to the financial reporting paper, paper number 1 of the new syllabus of the new course. So this is a very good RTP, I would say. The level of questions is fairly good. I would strongly recommend you to go through the RTP. A question or two is almost certain to come from the RTP, so please do go through the RTP. So what we have also done is we have outlined the questions, and though all the questions are fairly interesting, question number 5, the questions which have been highlighted, question 5, question 9, question 12, question 15, question 16 and question 20. These are the questions which I would recommend you to revise specifically. They're based on interesting concepts, quite different from the sums that are covered in your study material. So please do revise these questions. Well, we have also done the module-wise analysis, the module-wise weightage. And it's fairly interesting to see that a large part of the RTP comes from specifically 2 modules. That is, out of roughly 20 or 22 questions, 14 of them come from module 3, that is linked to assets, and module 4, that is linked to liabilities as well as disclosures like related parties and segment reporting. So do study these properly. This is in line, frankly, with your papers of May 18. In May 18, again, majority of the Ind-AS linked questions came from module 3 only. So do study Ind-ASs which are there in module 3 properly. Apart from that, as you guys would be aware, you would certainly get questions on consolidation for around 15 marks, business combination around 10 to 15 marks, financial instruments again around 10 to 15 marks, and share-based payment roughly around 8 to 10 marks. So these are sure shot questions in your exam. Apart from that, you have a whole host of Ind-ASs, from which I would say module 3 is the most important, followed by module 4 Ind-ASs, and then followed by module 2 Ind-ASs. Okay, I think this is missed over here. There are no questions in the RTP from module 7, the simplest of all the modules. Fair. So we'll jump to the questions quickly without investing more time. So we'll first start with question number 1. Okay, this question is on related party relationships. The question asks us to evaluate the related party relationships from the perspective of XYZ. Fair. So Mr. P is a director in XYZ whose wife, Mrs. P, acquires control in ABC Limited with effect from 1st of June 2017. The question asks us to evaluate the related party relationships between and the disclosures between XYZ and ABC specifically. Okay, so if we just evaluate the question, so Mr. P is a key management personnel as he's a director in XYZ, and hence Mr. P is a related party to XYZ. Now, if you remember the related party definition, a key management personnel along with close members of the family, relatives, are also related parties, which means if Mr. P is a related party to XYZ, Mrs. P, who is a wife of Mr. P, will also become a related party, to XYZ. Okay. However, entities over which a related party exercises control or a joint control will also be covered within the related party relationships. Now we have Mrs. P, who is exercising control over ABC Limited, and hence as ABC Limited is controlled by a related party of XYZ, related party of XYZ, there is a related party relationship, as you can see, between ABC as well as XYZ. However, this related party relationship comes into existence from 1st of June 2017. So as per Ind-AS 24, all the transactions that happen after the related party relationship is established should be specifically disclosed. Now this is irrespective of the fact that these transactions happen at arm's length, irrespective of the fact that they happen at a favorable terms or otherwise, irrespective of the size of the transactions, they have to be specifically disclosed. So the key points to remember in this question: well, Mr. P and Mrs. P are related parties for XYZ Limited. Okay, ABC is a related party with effect from 1st of June 2017. That is because it is an entity over which a related party has control or even joint control, and this would have been a related party. Okay. Now, what are the disclosures that you need to give? As a part of your notes to accounts of XYZ, you need to give the name and the nature of relationships. Well, the name and the nature of relationship is ABC, as well as entity over which a related party exercises control. The transactions, well, if you see, these are the transactions worth 60 lakhs. These are transactions from 1st of June 2017 to 31st of March 2018. Now, these transactions require a disclosure in the notes to accounts. Apart from the transactions, even outstanding balances do require disclosure. So outstanding balances will be disclosed as a part of notes to accounts. Well, these transactions are at favorable terms. As you can see, favorable credit terms, a 3-month credit period instead of a 1-month period, a roughly 20% discount. This disclosure is optional. Remember, you're not mandatorily required to disclose the favorable terms, or even if the transaction is at arm's length, you're not mandatorily required to disclose that. You're required to disclose the name and the nature of relationship, and you're required to disclose the transactions during the related party relationship. So the transaction during the first 2 months when the related party relationship was not in existence will not be disclosed. Additionally, you also have to disclose the additional balances. Okay, are we clear with this? Fair. It's a simple question, a fairly disclosure linked question. Okay, so with that we can proceed to question number 2. Now question number 2 is on leases. This is Ind AS 17. This is on leases. So A Limited, as per the facts of the question, A Limited purchases a machine for around 2 crores. There are a couple of printing mistakes in this question, I guess. The question, if you see your study material, it says the asset is acquired for 20 lakhs. It should actually be 2 crores over here. So the numbers type properly, acquired for around 2 crores. Okay, A Limited immediately leases it out to B Limited for a 10-year period. Now, if you see, the life of the asset is also 10 years. One of the conditions of a finance lease is if it is leased out for a major part of the economic life, and major part is generally constituted to be greater than 75%, in which case the transaction is classified as a finance lease. In this particular case, the lease is for the entire life, and hence it's a clear case of finance lease. So we are asked to show the accounting in the books of A Limited for the financial year ended 31st March 2018. So in the books of A Limited, the transaction from initial recognition would be classified as a finance lease. We are given that the lease rent is 27,87,000. Mind you, this lease rent is to be paid in advance, which means you're going to pay the rent at the beginning of the period. The question also gives you an interesting point on initial direct cost, that is for 2 lakhs, and also gives you an implicit interest rate of 8%. Now, there has been a fair bit of confusion among students on how do you account for initial direct cost in such cases. Well, in the books of the lessor, as per Ind AS 17, if there is any initial direct cost, that initial direct cost should be considered at the time of calculation of the implicit interest rate. Now, implicit interest rate honestly is the IRR. It is the internal rate of return that the lessor will earn on the transaction. So, well, we have been directly given this 8%. But if you see how this 8% would have been calculated, while calculating 8%, we would have tried to take the present value of cash outflow, and the present value of cash inflow. So while calculating the cash outflow, we would have taken 2 crore rupees, that is for the machine, and also taken the 2 lakh rupees, that is initial direct cost, and tried to find an IRR at which 27.87 payable in each of the years equates the two. So we have directly been given this 8%, but mind you, this 8% would be calculated after considering 2 lakhs. And hence, initial direct cost need not be separately accounted. A lot of students have problems over here that why is initial direct cost not taken in the P&L, not added. It would automatically be considered because it is a part while calculating the IRR. So while calculating the IRR, we would have taken the initial direct cost directly into consideration, and hence it is not separately seen in the solution of the question. Okay, so as we can see what is written, as per Ind AS 19, the implicit interest rate is defined in such a way that initial direct costs are automatically included in the lease receivable, and therefore the initial direct costs are not separately taken. Okay, fair enough. We'll just come back to this point again as a part of discussion of the solution. Okay, so we are asked accounting in the books of the lessor, specifically the disclosures that need to be done during the financial year 17-18. Okay, so the lease transaction started from 1st of April 2016. So at initial recognition, the lessor recognizes a lease receivable. As it is a finance lease, he would remove the asset from his books and book what value is a lease receivable booked. As per Ind AS 17, lease receivable is booked at something called as net investment in the lease. Now, how does one calculate net investment? Well, it is nothing but present value of gross investment. That is nothing but present value of cash flows. As a lessor, what is the cash inflow that I'm going to get? Well, as a lessor, the cash inflow that is going to be received is 27,87,000 in each of the years. Remember, this cash inflow is received at the beginning of the year. And as a result, you would receive cash inflow at the beginning of the first year, that is, we can say at year 0, and going forward for the remaining, for the balance 9 years after the first year is received. Well, the question tells you the implicit interest rate, and it also gives you the present value factor from year 1 to year 10 for payments which are at the start of the year, that is around 7.27%, 7.247. So the present value of future cash inflows, or something called as net investment, comes to around 2,01,97,389. This is a very interesting number. Mind you, you had acquired the machine for 2 crore rupees. So ideally, the present value of cash inflows should equal to the present value of cash outflows, that is 2 crore. But if you see the calculations, it comes to around roughly, I mean, if you remove rounding off, it comes to around 2 crore 2 lakhs. That is because the initial direct cost of 2 lakhs is automatically included in the finance lease receivable. So we are not asked the journal entries, but if you were asked the journal entries, you would have debited the lease receivable by around 2 crore 1,97,389, which is roughly 2 crore plus 2 lakhs. Credited the asset. Well, asset has a book value of 2 crores. You would have credited the asset by 2 crores, and additionally, you would have paid 2 lakh rupees as initial direct cost. So to bank would have been 2 lakh rupees, and hence the transaction is roughly recorded at around 2 crore 1,97,000. Are we clear with this? Yes? Okay. So this is an interesting point on the initial direct cost, which gets recorded. Okay. Now, once the lease receivable is recorded, we think of it as if it is a loan given, and against which we are not really getting rentals, we are actually getting a principal and interest repayment. So when 27,87,000 is paid in each year, we don't account it as rental income, we treat it as a repayment of installment. Installment includes principal and interest. Over here, I think there is an error in the institute's solution. The institute has considered that the repayment has happened at the end of the year, and hence if you see the interest calculation for the first year, they have taken interest on the entire 2 crore 1,97,000. Now that is factually incorrect, because the finance lease receivable will be recorded as 2 crore 1 lakh, and on the very first day, we have been told, mind you, that the lease rentals are paid at the beginning of each year, and hence at the very first day, the lessee will pay us 27,87,000. So the outstanding balances really will be 2 crore 1,97,389, that is column 2, minus 27,87,000, that is column number 3, and hence interest is charged on the opening balance after paying the installment. I think there is an error by the institute, so we have done a slightly modified solution. In this case, there are around 2 or 3 places in the RTP where I think the solutions as per the RTP are not absolutely accurate. So that ways we can calculate interest and closing balance. As you can see, closing balance is calculated after considering the repayment of installment and adding the interest. Well, this is the first workings for the year 16-17. The question asks us the extracts and the presentation to be done in the financial year 17-18. So in the financial year 17-18, the opening balance is around 1 crore 88 lakhs 3,220, out of which 2787 will be paid immediately at the beginning of the year. And on the net balance, that is 1 crore 88 roughly minus 2787, you will apply an 8% interest rate, and hence 12,81,298 will be the finance income. Now finance income will be shown as a part of other income in your P&L account. So as a part of your P&L account, you will show finance income as a part of other income. That is for the financial year 17-18, year ended 31st March 18. Additionally, the closing balance becomes 1 crore 72 lakh 97,518. Now a part of this closing balance is going to be received in the next year, in fact the very next day. 27,87,000 that you can see of the year financial year 17-18, this will actually be paid on 1st of April 2018, beginning of the year, and hence this should be classified as a current asset, and whatever is remaining is going to be received after more than 12 months, and hence the classification should be non-current asset. So when you look at the solution for the balance sheet extract, we can see that there is a lease receivable. A part of this lease receivable will be shown in non-current assets. This is after deducting the amount that will be received a day later, and the remaining amount will be in the current assets. Are we clear with this? Yes, okay. Again, our solution with the institute predominantly differs because of the interest calculations over here. Are we clear with this? Yes, okay. We can now proceed to question number 3. Okay, so basically question 3 has 3 subparts. Subpart A is linked to related party relationship. Subpart B is linked to the assets. Subpart standard. Subpart C is linked to intangibles. We'll just quickly discuss them. Okay, so over here you have Mr. Y. As you can see at the end of the question, Mr. Y is actually the managing director of the company. Right at the end of the question, it's not specifically given in subpoint A, but if you see at the end of the question number 3, Mr. Y is the managing director of the company, and being a managing director of the company, he is a related party because he is a key management personnel. So the transactions with the key management personnel or entities over which key management personnel have control or joint control are covered within related party relationships. So you have Mr. Y over here, who is a key management personnel. Mr. Y has 100% stake, that is control over PQR, who is having transactions with ABC. Now, Mr. Y is of the opinion in the first part that as the transactions are point A at normal credit terms, at normal terms, that is at arm's length, and at the same time very insignificant in value, that is around 1% or less, disclosure is not required. Well, the contention of the managing director is wrong on 2 grounds. First of all, Ind AS 24 nowhere mentions that the transactions with related parties should be disclosed only if they are not at arm's length. Whether they are at arm's length or not is not for the company to decide. Our job is to disclose it to the shareholders. The shareholders will decide whether the transactions are at fair terms or not. Secondly, the fact that the transactions are happening with the related party, that very fact means that the transactions are material. You don't need to look at the size of the transaction to determine the materiality. The fact that these transactions are happening with the related parties, they are considered to be material, and hence, even though the transactions are at normal terms, and even though the transactions happen are less than 1%, a disclosure is required. What do we give in the disclosure? Again, the same thing. The name of the related party, that is PQR, and the nature of relationship, that is an entity which is controlled by the key management personnel. At in the notes to accounts, you need to disclose the quantum of the transactions and outstanding balances, if any, at the end of the year. Are we clear with this? Yes, okay. So these are the broad things that we should be disclosing in subpoint A, a very straightforward part. Okay, proceeding to subpoint B. Now this is a fairly hodgepodge type of data given. So you have 3 assets. First is plant and equipment, which is shown under the cost model. Now plant and equipment is PPE, it is covered under Ind AS 16. Then you have owner occupied property, which is also PPE, which is covered under Ind AS 16, and Ind AS 16 gives you a choice. You can value the assets at the cost model or at the revaluation model, but that choice is given for a class of property, plant and equipment. What is a class of PPE? Well, assets which have a similar nature and end use are a part of the same class of PPE. So for example, if you have cars, let us say you have a Maruti Swift and you have a Honda City. Both of them are different cars, but they are belonging to the same, they have the same nature, same end use, and hence they form part of the same class of property, plant and equipment. But if you own cars and at the same time you own bulldozers, you own cranes. Now, having said that, both of them are automobiles, but the nature and end use of a car is very different from the nature and end use of a bulldozer, which is predominantly for construction. A car is predominantly for transportation, and as a result there are different classes of property, plant and equipment. So by default, a plant and owner occupied property are having complete. Owner occupied property would mean land or building, and they would definitely have a completely different nature and end use as compared to the plant and equipment, and hence they would be classified as different classes of property, plant and equipment. Well, if there are different classes given at the cost model and revaluation model separately, there is no inconsistency in that treatment. Now there is some investment property as well. Investment property is nothing but land or building which is held for the purpose of earning rentals or for capital appreciation. Now this investment property will be covered under Ind AS 40, the standard on investment property, and it is not covered under Ind AS 16. So basically this is covered under Ind AS 16, covered under Ind AS 16, this is covered under Ind AS 40. Now Ind AS 40 does not allow the revaluation model, does not allow fair value model. It requires all the assets and the plants to be recorded at fair value only. At cost only. It does not permit the fair valuation model, does not permit the revaluation model, and hence the entity has to show these at cost model only. Well, it requires fair value to be disclosed, but you can't pass a journal entry to bring the investment property to the fair value as per Ind AS 40, and hence even though it appears that the company is following different methods to value its assets, these methods are permitted and are in line with their respective Ind ASs, and hence with appropriate disclosure there is no inconsistency or wrong reporting by these companies. Okay, additionally the question also says that the depreciation is starkly different between plant as well as property, the percentage of carrying value. Now that is normal, because generally a plant would have a relatively shorter life and will be fully depreciated. A property on the other hand comprises of land which is not depreciated at all and building which has a fairly longer life, and hence the quantum of depreciation as a percentage would be much shorter, much smaller for a building and quite larger for a plant, and hence there would be a difference. Also, we have been told that a part of the revaluation, so you see owner occupied property being recorded as per revaluation model. We have been told that a part of the revaluation sometimes is taken into P&L, sometimes is taken into other comprehensive income. Now again this is in line with the Ind ASs, because if there's an upward revaluation is always taken into the revaluation surplus, and revaluation surplus goes into OCI. And initial downward revaluation, if any, is directly taken to the P&L account, and hence the entities may end up taking an upward revaluation, at least an initial upward revaluation to revaluation reserve, which is a part of OCI, a downward revaluation to profit and loss account. Again, there's no inconsistency. This is a treatment which is permitted and required rather to be done as per Ind ASs. Okay, and as a result, as you can see in these key points, the treatment which is given by the company is correct. Appropriate disclosures just need to be given. Okay. After that, we need to go to part C. Now, this is a very simple part. This is on intangible assets. Intangible assets. One of the basic points in intangible assets is the difference between research expenses and development expenses. Well, research expenses are those expenses which are incurred before the feasibility of the project is determined. You don't know whether you are going to get economic benefits or not. So, expenditure incurred during the research phase should be expensed to the P&L account. So, as you can see, the research phase in this case is from April 17 to September 17, and the company has expensed it to P&L account. There's nothing wrong in that. After September 17, that is from October 17, as we can see, the feasibility of the project is established, the viability of the project is established. So subject to conditions. Now there are conditions on legal feasibility, technological and technical feasibility, financial viability, product has to be viable. If all of these conditions are satisfied, from the date these conditions are satisfied, we say that the development phase begins. Development phase, the expenditure that you incur during the development phase should be capitalized as an intangible asset, and that is what the company is doing. So again, there is no error. All the three treatments that have been done by the accountant are actually correct. In the first subpart, the accountant wants to show the transactions with, I think, PQR as related party transactions, which is correct. In the second case, there are various different methods followed for different PPs. They are again in line with the respective Ind ASs. And in the third case, some of the expenditure, that is the research part, is expensed out, which is correct, and the balance expenditure, that is after October, is capital expenditure, which is capitalized as intangible asset. Again, this meets the requirements of the Ind ASs. Okay, so that takes care of all the three subparts of question 3. We'll proceed to the next question, question number 4. Okay, we'll continue to question number 4. So this is again a question, as you can see, on two specific standards which are linked to assets. There is a standard on investment property and inventories. So in this case, the property which is clearly given to you as land was originally acquired in around 2013, 1st April 13 at rupees 2 crores. Now the intention of this property was to be given out as a lease, as an operating lease, and if it is given out as a lease, an operating lease, a property will be classified as an investment property, land or building held as investment, and hence it will be classified as investment property. This investment property would be shown and will have to be shown at the cost model. Now you can see that the land gets remeasured in the sense the fair value of the land keeps on changing. It goes from 2 crores to 2 crores 60 and then goes to 2 crore 90. But because it is investment property, at least till 30th of September 2017, and as a result, during this entire period, this investment property, that is land, has to be shown using the cost model at 2 crores only. Now because it is land, it will not even be depreciated, and hence the carrying value of the investment property on 30th of September 2017 will be 2 crore rupees. Okay, now on 30th September 2017, we decide to develop this property in order to construct flats and then sell those flats, and hence this will now be reclassified. This property will now be reclassified as inventories, because these are assets which are holding for sale in the ordinary course of business, and hence it would be classified as inventories. Are we clear with this? Inventories, there will be transfer from Ind AS 40 to Ind AS 20. Now we have just inventory, and again that will be shown as WIP. Now we have just solved the question over here the way Institute has solved it. Again, according to me, there is an error over here. Okay, the institute says that the fair value of the property on the date of reclassification should be taken as a cost of inventory. If you open the Ind AS on Ind AS 40, it is quite clearly written over there that the cost, if there's a transfer from fair value to if there's a transfer from investment property to inventories or PP, the carrying value of the property does not undergo a change, so your carrying value continues to remain the same. So ideally this should continue to remain 2 crores, and we are just giving you the way Institute has solved it, but according to me 2 crore would be a more appropriate calculation. So we will take that the cost of the property is the cost of the investment property will be taken as the carrying value for the inventory. Now subsequently you are incurring certain construction costs. Now this is necessary to bring the inventory in the location and condition as desired by the management, that is the flat should be ready, and hence that cost should be added to the cost of the inventory. So we add 60 lakhs. So ideally you should be getting 2 crores plus 60 lakhs, that is 2 crore 60 lakhs. Okay, so at 31st March 2018, the inventory should appear at 2 crore 60 lakhs. I'm just giving you the solution because if you are comfortable with the way Institute has solved it, you can do it that way, though I would strongly suggest that the correct way is, this is the carrying value, this is the carrying value. So we're just giving you the solution on both sides. I would still say that the solution that I write in red is the solution that you should be solving. Or you compare with the net realizable value. Now, why do we need to compare it with net realizable value? Earlier, the investment was classified as investment property, in which case you don't need to compare it with the NRV. However, inventory is valued at cost or NRV, whichever is lower. As you can see that the cost is 2 crore 60 lakhs. The NRV of a completely ready flat would be 50 lakhs. Each flat would sell for 50 lakhs. But in order to complete those flats worth 50 lakhs, you still need to incur a cost of 40 lakhs. And hence the net realizable value is the estimated fair value less the estimated selling expenses, which we are not given, less the estimated cost of completion, and the estimated cost of completion is 40 lakhs. So you compare the NRV, and the NRV comes to 4 crore 60 lakhs, and hence the inventory will be valued at the lower of the two, cost or NRV, whichever is lower, and hence the inventory gets valued at 2 crore 60 lakhs. Are we clear with this? Apart from that, as per the institute solution, there will be a fair value gain of 90 lakhs. We would not consider this gain. Generally, this gain will be realized when you actually sell the property. Inventory, the gains are realized when you actually sell it. You don't realize gains when you actually reclassify it from investment property to inventory, as the case may be. Apart from that, in the first 6 months, the property was held as an investment property and we would have earned rent, and hence lease rent income would be recognized as an income of 10 lakhs as a part of other income. Okay, are we clear with this? Okay, so that takes care of question number 4. Well, next we go to question number 5. Now, this is an interesting question. This is a question on business combination. Okay, so if we go through the question, there are various types of considerations. The question requires you to calculate goodwill and find out the amortization on goodwill. Goodwill, remember, is calculated on the acquisition date as purchase consideration plus the non-controlling interest less the net assets taken over. When we calculate the purchase consideration is calculated at fair value of the shares issued plus the fair value of contingent consideration, if any, plus if there's a deferred consideration, which means the consideration is not contingent but it is just paid at a future date, then the present value of the contingent consideration should be recorded. So the question asks you to calculate goodwill using both the bases of NCI. NCI, as per Ind AS 103, non-controlling interest, can be calculated either using the fair value method or using the proportionate net assets method. So under the fair value method, the answer that we get is called as something called as full goodwill. Under the proportionate net assets method, the answer that we get is something called as partial goodwill. In any case, your purchase consideration, that is the consideration that you agree to pay for the 75% stake that you acquired in JKL Limited, is going to be the same. The valuation of NCI would be different. Okay, so first, if you go to your sub point 1, there are 3 bullet points which help you in the purchase consideration. The company agrees to issue 2 shares of the new company for every 3 shares held, and hence to the existing shares of JKL, that is 1 crore 20, we apply an exchange ratio of 2:3. Okay, now a lot of students directly apply this exchange ratio. We need to remember that only a 75% stake is acquired, and hence we get 75% stake over here. Okay, now these are shares of ABC that you are issuing, and hence we will get around 90 lakh shares. So over here, this will be 90 lakh shares of JKL into 2/3, and this is 60 lakh shares that you are issuing of ABC. Each share of ABC is worth 6.5. Now, share of JKL might be worth 6, but we are issuing shares of ABC. So the fair value of the consideration that we are giving is worth 6.5, and hence your purchase consideration in terms of shares issued is 3 crore 90 lakhs. Apart from that, the second subpoint you see, payment is going to be made after 1 year. Now, there is no uncertainty, there is no contingency, it is not linked to anything. You have to pay around 71,50,000. You have to pay 71,50,000. Just that, it is payable after a year. The question at the end tells you that the cost of borrowings, that is like the discount rate, that if you don't pay the money after 1 year and if you have to pay it today, you might have to borrow money, in which case you will incur a cost of 10%, and hence this can be taken as a discounting factor. So we find the present value of the deferred consideration. The present value of the deferred consideration is 65 lakhs, which is same irrespective of the way you value NCI. Okay, and we try to find the fair value of the contingent consideration, which is given to you in the question. Now, there are 3 values given. First is 3 crores, that is a maximum value. Second is the fair value expected on the acquisition date, that is around 2 crore 50 lakhs. And third is 2 crore 20 lakhs, that is the fair value at the end of the year, that is 31st March 18. Remember, goodwill is calculated on the date of acquisition. So you need to take the fair value of the purchase consideration of the contingent consideration on the acquisition date, that is 2 crore 50 lakhs has to be taken on the acquisition date. Are we clear with this? Okay, so this will be a part of our PC. Your total PC will be 7 crore 5 lakhs. Your total PC will be 7 crore 5 lakhs. This is irrespective of the method that you value NCI. Okay, now there are 2 methods to value NCI, are the fair value method and the proportionate net assets method. Under the fair value method, we will try to find the number of shares which are not owned by ABC Limited in JKL Limited. Well, JKL Limited has a total of 1 crore 20 lakh shares, out of which 25%, that is 30 lakh shares, are not owned by us, by ABC Limited, and hence 30 lakh shares represent the non-controlling interest. Now, the value per share of JKL. Now these are 30 lakhs, mind you, these are 30 lakh shares of JKL Limited. The value per share of JKL Limited is rupees 6. Therefore, 30 lakhs into rupees 6, and that will give you 1 crore 80 lakhs. This will be your non-controlling interest. Are we clear with this? Okay, now we'll keep aside the calculation as per net assets method for the time being. So this will give you a total of 8 crore 85 lakhs. Now this is your total PC plus non-controlling interest. Against this, you will take over the entire net assets, 100% of the net assets of the company. You have been given the book value of the net assets in the books of the old company is 6 crores. However, the fair value is 7 crores. Now, as per Ind AS 103, you take over all assets and liabilities at fair value, and hence you should take it over at 7 crores. However, you are also given a tax rate. Now, this is a slightly interesting adjustment. There's a hidden deferred tax item over here. Now, if you go to Ind AS 12, that is on deferred tax entirely is based on comparison between carrying value and the tax base. Carrying value is a value that will be recorded in the books of accounts, in this case, books of accounts of ABC, and tax base is a value as per income tax. Now, as per Ind AS 103, that is books of accounts, assets and liabilities are going to be taken over at fair value. Fair value over here is 7 crores. However, if you remember in Income Tax Act, what happens is you will continue the block value. You will continue the block value of the assets, and as a result, the value of the assets as per income tax continues to be 6 crores. That is the carrying value of the old company. Hence, there is a temporary difference. Now, there's a difference in the books. The carrying value of the assets is 7 crores and the tax base, that is around 6 crores. So, the difference between the two, that is 1 crore, is a temporary difference, which if you multiply it by the tax rate, that will give you your deferred tax item. Now, as the carrying value as per books is greater than the tax base, if the carrying value as per books is greater, the deductions overall in the books will be higher and income tax will be lower, and hence this gives rise to a deferred tax asset. This gives rise to a deferred tax liability. So you will record this as a deferred tax liability. Remember, the general principles in deferred tax are, if the carrying value of the assets is greater than the tax base, it gives rise to a deferred tax liability. If the carrying value is lower than the tax base, it gives rise to a deferred tax asset. In our case, the carrying value of the assets is greater, and as a result, carrying value, because of value in the books is 7 crores, and as a result, this will give rise to a deferred tax liability. So this is a hidden adjustment over here, the difference between the carrying value and the tax base into the tax rate. This will give rise to a deferred tax liability, and hence the net assets taken over will be 7 crore minus 20 lakhs, a liability, deferred tax liability, that is 6 crore 80 lakhs. So when we take the goodwill calculation, we take over the net assets at 6 crore 80 lakhs and calculate goodwill as a balancing figure, that is 2 crore 5 lakhs. Now this goodwill, 10% of this goodwill is to be impaired. Remember again, as per Ind AS, goodwill under business combination should be annually tested for impairment, and under impairment we have found that 10% of the goodwill is impaired, and hence we will recognize 10%, that is 20,50,000 as an impairment loss in the P&L account. If we do the valuation as per proportionate net assets, as we see in the working note below, the net assets are 6 crore 80 lakhs. 25% of that belongs to the non-controlling interest, and hence NCI. Henceforth, your calculation remains same, 8 crore 75 minus 6 crore 80, and we get partial goodwill as 1 crore 95 lakhs, 10% of which would be subjected to an impairment, and hence 19,50,000 is the value of impairment loss. Are we clear with this? A very interesting question, I would say, specifically the calculation of PC. You have a lot of varieties, and in net assets, you do have deferred tax adjustment. Remember, when do we consider deferred tax? In all those questions when the carrying value and fair value is different and the tax rate is given. Take the difference between the two, multiplied by the tax rate. If the carrying value of the assets is greater, then that gives rise to a deferred tax liability. Carrying value of the assets is lower than the tax base, that gives rise to a deferred tax asset. Okay, fair. So that takes care of question number 5. We proceed to the next question, that is question number 6. Okay. So we go to question number 6. This is on deferred tax. Now there are 4 subparts of this question. We'll just do a quick run through. We don't have enough time. We'll do a quick run through on deferred tax. Remember, there is deferred tax asset and there is a deferred tax liability. We have just jotted down the general deferred tax principles. So whenever there is an underlying asset, what do we need to compare? We need to compare the carrying value and the tax base and determine whether there is a deferred tax liability or a deferred tax asset. So if there's an underlying asset, for example, something like preliminary expenses under section 35D, the carrying value of the asset as per books and the tax base. So let us say in the first case you take an example of depreciation, block value. You get a lower depreciation in income in books of accounts, a higher depreciation in income tax, and as a result the carrying value as per books is greater. In which case the carrying value as per income tax is lower. The difference between the two will result in a deferred tax liability. The difference between the two carrying values and the tax base into the tax rate. If there's an underlying asset and the carrying value is lower than the tax base, for example, preliminary expenses. So when we look at preliminary expenses in the books of accounts, let us say that preliminary expense of 5,000, you'll write off the entire expenses. The general entry preliminary expense account debit to cash bank, P&L account debit to preliminary expenses, carrying value becomes 0. In income tax section 35D, a deduction over a period of 5 years, in which case you would have the tax base to be the general entry be preliminary expense account debit to cash bank 5,000 and P&L account debit to preliminary expenses only 1,000, 1/5. So the balance 4/5 will still appear in the income tax book. So your tax base will be 4,000, carrying value will be 0. The difference between the two, 4,000 into the tax rate, will give you a deferred tax asset. Then you have liability situations where carrying value of the liability as per books is greater than the than the tax base. For example, 43B items. So under 43B, even if the interest is not paid, interest to a scheduled commercial bank is not paid, you would still recognize the interest in the books, which means interest account debit to provision for interest or interest payable. So carrying value of interest in the books will be, let us say, 100 rupees. Income tax will not allow you to pass the journal entry. It will say that you cannot claim a deduction till the time you actually make the payment. If you cannot record an expense, well, you cannot even recognize a provision. So no entry will be passed, and as a result, the tax base will be 0. There is a difference. The carrying value of the liability is greater in the books, lower in income tax. This situation will give rise to a deferred tax asset. And lastly, if there's a liability, the opposite, exact opposite. If the carrying value of the liability is lower than the tax base, that gives rise to a deferred tax liability. What is a deferred tax asset? Well, deferred tax asset is very similar to a prepaid expense, which means more tax is paid in the earlier years at the benefit of paying a lower tax in the future years. A deferred tax liability is like an outstanding, which means you might technically pay less tax in the current year, but you're not really saving tax. You are merely postponing, deferring tax, and hence that creates a deferred tax liability. Okay, so these are just general deferred tax principles. Students generally are a little confused in deferred tax. You can just remember this table in case you are finding a difficulty at this hour before your exams. Okay, so when we are looking at deferred tax, 4 specific situations given. The first situation, you have a carry forward loss. Now carry forward loss will typically give you a deferred tax asset. Why? Because that will help you in paying lower tax in the future years. So it is creating a deferred tax asset in the current year. But if you have to create a deferred tax asset, as per Ind AS, you should be in a position you should be at least reasonably certain to have enough temporary differences against which you can utilize that benefit, or you should generate sufficient taxable profits. Just say income tax you are allowed around 8 years. You can carry forward the profits, the losses for 8 years and set off against profits. But what if you don't make profits in 8 years? That means the losses do not really help you in saving any tax in the future years, and then there's no point creating a deferred tax asset. Or if there's the existence of a potential tax strategy, even then you can create a deferred tax asset. In the given situation, you have been quite clearly given that there are carry forward losses. However, the company does not foresee enough taxable profits in the future years. In absence of any temporary differences, in absence of taxable profits and no information given on any tax strategy, in which case you cannot recognize a deferred tax asset because you do not have sufficient profits against which you can utilize those assets. So this would be recognizing an asset for which you might not even get any future economic benefit. So in the first case, no deferred tax asset can be created. Okay, in the second case, you have if we go through the question, okay, so you have closure of a division for which you are going to make a payment to the employees. Now, as per books of accounts, we have been given that the provision will be made immediately, and hence we will pass the journal entry. Let us say over here, P&L account debit to provision. You will pass the entry for the entire amount of 20 lakhs. So the carrying value as per books is 20 lakhs. Income tax, you will record the entry only when you actually make the payment. In which case, there will be no entry that is passed. If there is no entry, that tax base over here is nil. So this is carrying value of the liability, carrying value of a liability being greater than the tax base of the liability, and hence this situation gives rise to a deferred tax asset. So as you can see, there's a deferred tax asset of the difference into the tax rate, that is 20%. In the third subpart, we can see, we can just go through the question again. In the third subpart, there is an intangible asset. There is a development expenditure. As you guys are aware, under Ind AS 38, intangibles development expenditure is capitalized. We have been told that as per income tax, this expenditure is expensed off immediately. So your total expenditure is 16 lakhs. Which is capitalized as per books. You would have passed the entry intangible asset account debit to bank. Income tax would have said profit and loss account debit to bank. The entire amount would have been taken as an expenditure. Now this intangible asset would be amortized. The question tells you that it is amortized over a period of 5 years, and during the current period, the intangible was capitalized on 1st of January, and hence the carrying value at the end would be 15 lakh 20. Remember, income tax would have passed the entry expenditure account debit to bank, and hence balance sheet would have no tax base. So this is an asset. The carrying value of the asset is greater than the tax base of the asset, and as a result, you would create a deferred tax liability for the difference in the amounts into the tax rate, and that is 3,04,000. Next, you have the last case where you have borrowing costs. Now, there is a slight application of financial instruments. You have actually borrowed, and on borrowing, the effective interest comes to 10%. I think, yes, the effective interest is 10%. Again, there's a transaction cost. So, as per income tax, the transaction cost will be expensed. The loan continues to remain at 1 crore. So, your carrying value as per income tax is 1 crore. Expenditure taken to the P&L. Bank account debit to loan shown at 1 crore rupees only. However, as per books of accounts, if you remember financial instruments, the initial recognition happens at the fair value plus or minus, in this case being a liability, minus the transaction cost, and hence the initial recognition happens at 98 lakhs. Again, you don't wait till the last year when you're supposed to repay around 1 crore 30 lakhs and something. You recognize it using the effective interest method. The effective interest being 10%, so you will increase the carrying value by 10% at the end of the year. The year will appear at 1 crore 7 lakh 80,000. If you look at this is actually carrying value of a loan, that is a liability. This carrying value is again greater than the tax base, and this situation will again give rise to a deferred tax asset. As you can see, in the last case, there's a deferred tax asset which reflects the difference of the two. Okay, so this takes care of question number 6. We'll then proceed to question number. Okay, question number 7 is again on intangible assets. Now this is a very simple question, I would suggest. So there is a total expenditure of 12 lakhs which is incurred for advertising. Now the company's top management feels that since the benefits are going to be received over a period of years, we should amortize this over a period of years. However, that is not in line with what Ind AS 38 says. Ind AS 38 considers advertising expenditure to be expenditure. It does not meet the identifiability criteria of intangible assets. It does not arise due to a separate contractual or legal right, nor is it separable and saleable as a separate asset, and hence advertising expenditure is specifically required to be expensed out, which means we should expense out the advertisement expenditure, and we cannot capitalize it as an intangible asset. Having said that, the expensing can happen only as per accrual basis. Now you can't just expense out everything merely because you have paid an expenditure. As we can see in the question, your total advertising expenditure is 12 lakhs, out of which for 17-18 what pertains is 8 lakhs. Something that is paid in 17-18 is 8 lakhs, and after 17-18, that is in the year 18-19, 4 lakhs is paid. Out of the 8 lakhs, we have been given that 7 lakhs pertains to the year 17-18 and 1 lakh pertains to the year 18-19. In which case your journal entry actually in the year 17-18 would be advertising expenditure account debit 7 lakhs, prepaid advertisement expenditure account debit 1 lakh, to cash bank 8 lakhs. You cannot expense out the entire 8 lakhs merely because you've paid 8 lakhs. You are not following the cash system of accounting. You are following the accrual system of accounting. Okay. In the year 18-19, your total expenditure is 4 lakhs. Now that is expenditure paid in 18-19, incurred also in the year 18-19, and hence no entries will be passed in the year 17-18. So though the total expenditure on the advertising campaign over the 2 years might be appeared to be 12 lakhs, the advertisements that were aired or shown in the year 17-18 are 7 lakhs. These advertisements will be expensed off to the profit and loss account, and 1 lakh will be shown as prepaid expenses. 4 lakhs will be shown in the next year as and when these advertisements are going to be shown. So a very, very simple question. Advertisement, not an intangible asset, should be expensed, but expensing should not be based on cash or payment basis, should be based on accrual basis. That takes care of question number 7. We go to question number 8 now. Okay, so question number 8 is linked to foreign exchange. Again, this is a fairly straightforward question. So the entity has purchased machinery for $2 lakh on 1st of January 2018. As per Ind AS 21 foreign exchange, this transaction should be recorded at the exchange rate prevailing as on the date of transaction, which is 68. Should pass the entry bank account debit to loan for taking the loan, that is at the rate of 68, and you will use that money to buy the asset, that is machinery account debit to bank, again at the rate of 68. The transaction getting recorded at the exchange rate prevailing as on the date of the transaction. Okay, going forward as per Ind AS 21, loan is a monetary item, should be remeasured at the closing rate, whereas machinery is a non-monetary item and hence has to be continued at the historic rate. So machinery will continue to remain at 68, however loan will be remeasured at 65. So as on 31st March 18, you will remeasure the loan. Now, there is a slight error, I think, again in the institute solution. There's a printing mistake. They have calculated the amount of loss correctly, that is 6 lakhs, $2 lakh into 3 rupees per dollar. However, this is a clear-cut case of foreign exchange gain. Remember, the liability, the loan, was shown at 68. That gets remeasured and becomes 65, which means you have to pay less. Well, if you have to pay less, that is a foreign exchange gain and not a foreign exchange loss, and hence this transaction should be shown as a foreign exchange gain. So your entry will be loan account debit to foreign exchange gain. Your loan gets remeasured at the rate of 65. Machinery, remember, will not be adjusted because it is a non-monetary item. Machinery would be depreciated. Well, if you see the question, in the question we have been told that the CFO or the management contends that as the asset and liability is denominated in rupees, which was the same amount, there would be no impact. Now that is incorrect. These fluctuations would affect the financial statements because as per Ind AS 21, one of the items is monetary, one of them is non-monetary. So loans result in recognizing a foreign exchange gain. On the other hand, on the machinery, we do not recognize any foreign exchange gain or loss, and hence this transaction will clearly impact the financial statements. The contention is incorrect. Okay, fair. So that takes care of question number 8. We then go to question number 9. Now this is a very interesting question. A lot of students do face problems in this question. This is on employee benefits. Now there are various ways in which you can solve this question. Remember, there are various ways in which you can solve this question. We have adopted a slightly different presentation as compared to the institute, though our end solutions continue to remain the same. This is only because it is much more easier for a student to connect using this entire presentation. So when we are trying to find the position as on 31st March 2018 as per Ind AS 19, we have been given actuarial valuations. We have been given actuarial valuations, as you can see at the beginning. So your opening obligation for the liability is 6 crores. Whereas the opening fair value of plan assets is 5 crore 20 lakhs. The institute shows it as a net benefit. The net amount will be disclosed in the balance sheet, which is absolutely fine because eventually your disclosure in the balance sheet is going to be the net amount. So, however, we show gross, we show everything separately so that a student can clearly connect the impact. Sure, liability opening value as per actuarial valuation is 6 crores and the liability opening value, the fair value of plan assets is 5 crore 20. Okay, during the year, as you can see, actuaries have said that the current service cost is there. So the current service cost will increase your expenditure for the current year, defined benefit expenditure, and at the same time that will increase your liability. So these are the two effects. Secondly, remember, the liability changes due to time, and as per Ind AS, we have been quite clearly given that the discount rate is the rate that you expect to earn on the plan assets. So the discount rate or the rate of return is given to you as 5%. So your opening liability, the contributions, benefits, etc. have been paid at the end. The opening liability is worth 6 crores for the year. Now that opening liability is now one more year closer, and hence interest will have to be recorded due to passage of time. That will be 6 crores into 5%. Again, this is an expenditure as it increases the liability. So we have taken 3 crores as an interest expense. As per Ind AS, ideally you have to show the net interest expense. At the same time, your plan assets are also expected to give you a return of 5%. That is the discount rate, really, the return that you are expecting on the plan assets. And as a result, your expected return on plan assets is 26 lakhs. Institute has directly taken the net interest, which is also correct, where they have taken directly the difference between 6 lakhs and 5 crore 20 and directly applied a 5% rate. So 8 lakhs into 5% is still 4 lakh rupees. That is the same amount, though we have just given a slightly more detailed disclosure. Okay, after that the question tells you that there are some past service costs. Now these are due to changes in plans which the entity might have done, and hence past service cost, in absence of any vesting period, will directly be taken to the profit and loss account. It increases your expense. It is a higher expense due to a change of plan in the current year. At the same time, it increases the liability. That is the second effect for the past service cost. It has no impact on the plan assets. Now there is this entire adjustment on redundancies. Now redundancies are very similar to curtailment. You're curtailing a plan, settling it, giving off money. So there is some curtailment or redundancy that is happening, which is resulting in a reduction of liability by 80 lakhs. So you will debit the liabilities by 80 lakhs, as you can see. You will debit the liability by 80 lakhs, but at the same time, the compensation that you are agreeing to pay is not 80 lakhs. You are agreeing to pay a compensation of only 75 lakhs for that. And as a result, now how will you pay the compensation? You will have to sell some of your plan assets in order to pay the compensation. And as a result, 75 lakhs will be reduced from your plan assets. That is as redundancy compensation. At the end of it, for something which was worth 80 lakhs, you are actually settling it up today by paying 75 lakhs, and as a result, there is a net gain on curtailment or redundancies which will be taken directly to the P&L account. So this is the 5 lakhs gain that is taken to your profit and loss account. Okay, apart from that, you have certain contributions. Contributions increase plan assets. They are not expenditures. They are just investments in plan assets. So that is plan assets account debit to bank. We will make contributions. At the same time, we have paid benefits. Now, these are apart from the redundancies. You have paid a benefit of 42 lakhs. How will you pay a benefit of 42 lakhs? You will have to sell a plan assets, generate 42 lakhs, and use those same 42 lakhs to pay a plan benefits. And as a result, your plan benefits your plan assets as well as your plan liabilities both will reduce by 42 lakhs. Now this would consider almost all transactions. So ideal value, well, we are given the closing actuarial valuation at 6 crore 80 and closing fair value of plan assets at 5 crore 60, which effectively means that your closing value should tally with your calculations. You see that it won't. That must be because actuaries would have changed assumptions during the year. Remember, even in practice, the balancing figure is the only way you calculate a changes in actuarial assumptions. You have the opening liability, make all the changes as per actuarial valuation, try to find the closing liability. Ideally, it should tally with the actuary's valuation. If it does not, that must be because of certain remeasurements or changes in actuarial valuation would have been done. Actually might have changed the assumptions on mortality, the assumptions on attrition, the last drawn salary, etc. And hence the balancing figure is taken as changes in actuarial assumptions. Remember, as per Ind AS, there are 3 items which will be recorded as remeasurement items which go into OCI. That is the changes in actuarial assumptions, the balancing figure in the plan liabilities, the difference between actual return and expected return, that is the changes in return, which is nothing but a balancing figure in the plan assets, and the difference is due to an asset ceiling. Now, there is no asset ceiling adjustment given thankfully in this question, and as a result there is no effect. So you have 95 lakhs and 61 lakhs. Now these amounts are going to be appearing in the other comprehensive income under OCI. Remember, if this was an AS15 question, and you do have AS15 in your syllabus as well, there's nothing called as OCI, other comprehensive income, in AS15 employee benefits. This will be then directly taken into the profit and loss account. However, under Ind AS you do have OCI, and hence these two numbers go into OCI. Institute has done everything on a net basis, becomes slightly difficult for a student to understand, though the balancing figure even over there appears to be 34 lakhs. We have decomposed the plan assets, plan liabilities, expenses, the detailed disclosure that appears, and found out 34 lakhs. Having said that, at the end, when you look at the balance sheet, in the balance sheet there will be a net reporting of liability less plan assets, and you will see the number of 1 crore 20 lakhs appearing in the balance sheet. Okay, now this is a very interesting question. It clears a lot of your concepts of Ind AS 19 employee benefits. Almost same solution for AS 15, except for the fact that there would be no OCI. In fact, the balancing figures will directly be taken into the profit and loss account. We would continue the other questions in the next part of the video. If you enjoyed, please like, share, subscribe. Thank you.